I hope your NFL brackets predicted the Seahawks versus Patriots, because then you would have won big. But, while you're out celebrating your win or mourning your loss, keep in mind that you are far from the only one doing it. Sports betting and prediction markets are one of the fastest growing social investment trends, but how much of a risk are you really taking compared to traditional methods of investing? Stay tuned to find out. Welcome back to Road to Riches, everybody. Today we have a good topic. We're going to talk a little bit about risk and risk management with the different investment products that you might be thinking of. To start off, we have an article actually talking a little bit more about sports betting and prediction markets from the Wall Street Journal. Um, as they say here, sports betting, prediction markets, they're one of the fastest growing social trends. Um, to some people, they're actually somewhat considered gambling, and there actually are a few lawsuits on the books right now to determine, especially for prediction markets, should they be legal, and if so, should they be regulated as investing or as gambling? There are a few different distinctions between those two, which is why some states actually do have both of these things illegal. Uh, However, there's still a possibility that you actually could win some money, particularly if you know what you're doing. If you're a big sports fan, or if you bet on something that you consider to be relatively safe in a prediction market. Um, for example, I saw one recently actually where someone bought in on whether or not there'd be a government shutdown at the end of this month, when it was like 10%, and at this point, their odds have gone up to now it's like 69 cents per share or whatever that they got on there. So, Matt, what do you think about these trends that we're seeing now, and are they even good for people to be getting into?
Yeah, so the sports betting market, especially, I'll touch up on that first, since it's sort of the oldest. It was only just now that we're doing it digitally, but we've actually been sports betting for a very very long time. So I'll touch up on sports betting first. The sports betting market, especially with websites like Kalshi and you have Price Picks, other websites like that. They're people. You start to realize when you go into these markets that people are actually kind of smart. They know what they're talking about. One thing that did shock me, just a little anecdote here, was that the Indiana was still only 63% likely to win the national championship, even after they had destroyed Oregon in the semifinals. So I thought that was kind of funny, but I think I mean, I'm not necessarily opposed to it. I think that there are certainly a lot of how we know them as unsystematic risks to sports betting, which essentially means problem diversifiable risks, things like that, where you look at the team, you look at the coaches, the players, injuries within the team, everything like that. And you know, with sports betting, it's interesting. It's not like stocks or real estate or anything like that, because you can't necessarily diversify away that risk. I mean, you can, it would just take a lot of money. Uh, because it's so unpredictable. Anything can happen, especially in college sports. Anything can happen. Indiana can hire Kurt Signetti and then, go to the playoffs the very next year and then win the national championship the next year. Anything could happen. Uh, and as an OU fan, OU can beat Alabama in the regular season and then get beat in the opening round. So take that with a grain of salt. It's very very volatile in that regard. Uh, and so the online sports betting market is very very interesting because uh, it's unpredictable, it's volatile, and people get very very serious about it. I know a lot of my friends, even though it is so volatile and it is so unpredictable. They're very serious about it. And I mean, and it kind of brings a new level to fantasy sports, you know, because we had fantasy sports. People were really into that, uh, especially financial gurus. You know, were statistical nerds anyway, so might as well get into financials. Might as well get into um, you know fantasy sports, and make a little money off of statistical analysis in that regard. Well, now we have sports gambling, so it takes the whole team out of it. Some would say it takes the whole fun out of it. Uh, and so in terms of what sports betting is like against the other assets that you can bet against or bet with, stocks, bonds, etc. It's I would say sports betting is one of the higher risk activities you can engage in, and we'll see that later on in the episode. But I just wanted to start off with that.
Yeah, I mean, I feel like that's a great analysis right there, just starting out the gate. Before we do go a little bit further, I do want to take a step back real quick and actually kind of explain for those who don't know what really is a prediction market and how does that differ between something like sports betting. And then, you mentioned a couple terms of risk in there, systematic and and non-systematic, diversifying things like that. Um, so the first thing that we need to know is that sports betting, as you said, is it's pretty simple. Whether it's a fantasy league, whether it's just directly going to a friend and say, "Hey, the game's coming up this Saturday. Who do you think's going to win? I've got $5 on it." Or whether it's a digital market or something like that. DraftKings was one of the originals. FanDuel. The article that we're seeing here actually talks a little bit about them. How it says that these companies have been around for years at this point and made huge markets of sports betting, fantasy leagues. I mean, these things are everywhere. You used to not see them a whole lot, but now you're getting, nationally recognized channels are showing ads for these things, and that mainstream pushing of these topics is something that could be considered you know dangerous for some people because a lot of folks don't realize just how much money you can stand to lose, and a lot of people that have gambling addictions are going to see this as an easy way to do it from home. I mean, just you take this and then you add in things like the bingo apps and the apps where you can like do lotteries and things like that. I mean, just we have so much of an easy access to gambling now that I find it honestly a little bit troubling. I mean, you see right here, the article says that these things are even illegal in 11 states, so two of which are some of the biggest states, California and Texas. And then it says nine others. Sports betting is just illegally. But prediction markets sneak in a little bit differently. They're more so concerned or marketing themselves, that is, more so as an investment product than a form of betting or gambling. And the reason why that is because they fundamentally act differently than a lot of these other things. When it comes to sports betting, you have odds, you have over unders and things like that, and the bookie or the person who's in charge of it, they manage those things. When it comes to the prediction markets, they function fundamentally different. Where they differ is basically you put in money to purchase a share in something, in some event, an outcome of an event. And instead of these shares having odds, or having a market through a bookie, even though the platform still manages them, they actually are more so like a traditional investment where you do have the natural rise and fall. There is no set odds. It's a more continuous thing. Um, Generally, you can't necessarily pull out your money at any time until the event actually happens. Um, but because they inherently function more like a peer-to-peer market instead of actual gambling, that tends to be why they're federally regulated more so as an investment product. Um, But as you said, with these things, there's risk that you can't diversify away. Diversify simply meaning, if I think that, um, let's say with the Pope, that was a pretty big one that happened, not too long ago, where people were basically buying into the prediction market, saying, number one, what country is the Pope going to be from, and then once that got kind of narrowed down, then they started betting on who the new Pope himself is going to be. So if you can't necessarily make your bet in a prediction market saying, "Hey, I think the next pope is going to be uh, from Spain," and then also turn around and say, "Well, I think they're going to be from the U.S." Although you can just straight up buy into that and do it to some degree, that's not exactly how this system works. It's a difference between saying, "Hey, I'm going to bet for and against myself," based on just my thoughts or the possibility that something can happen, especially because in order to win on one of them, the other inherently has to go down at least that same amount. So you can hedge yourself, but you're never going to actually come out ahead if you do something like that. Versus where, with a traditional more investment product, if you were to look at options, for example, then you can, you know buy some shares of a company, say Walmart, hoping that it'll go up, but then say if it doesn't, then now I'm going to buy a put contract saying, well, if it doesn't go up and it happens to go down, well then now I still have the right to sell these shares at some amount and limit my loss. That's what a hedge is in that scenario, and that's one thing that you can do for risk management is hedging those losses. So since you can have that hedge, and then you also mentioned diversification, that in itself is simply a strategy to buy different things and spread the risk out. So we use the example of Walmart. If you have shares in Walmart, if you want to diversify away, we'll say, well, this industry is groceries, food chains, right? Assuming that Walmart stock goes down and the grocery store or supermarket industry as a whole goes down, what can I buy to spread out some of that risk instead of having all of my investments in Walmart? Well, now I'm going to take a look at maybe GameStop or some other thing there. Maybe I'll take a look at restaurant stocks. Maybe I'll take a look at utilities or oil and gas. You have all these different options that you can do to spread out your risk. And while you can still say, well, hey, I can just, buy into a bunch of different prediction markets and see what happens there. But ultimately, there is no true backing for these things. If you were to give your money away and then Kalshi were to or Polymarket were to shut down the very next day, there's no way of getting your money back. There's no, because you don't actually have anything that you own versus if you had bought parts of a stock or bought treasury bonds or something like that. At this point you can say, well, Charles Schwab has shut down, Vanguard has shut down, they're no longer going to hold my investments, but because I still legally own these things, I can just go to them and redeem the actual shares and send them to Robinhood or Webull or someone else, because there is still the backing of the actual product. And even if, we go back to that Walmart example, if Walmart were to go bankrupt tomorrow, then even though their underlying stock were to go down, then depending on if you bought, shares, if you bought preferred corporate bonds, whatever the case is, now you still have somewhat of a claim to those assets. You have a chance to make some of your money back because those assets are directly backed by the value, which includes the assets, the hard assets of that company. If Walmart went bankrupt, they were to remove their stock from the market, shut their business, then they're going to sell all their stores, they're going to sell all their real estate, sell all their current inventory, and they're going to start paying back their debt holders first, which would be the other businesses that they do business with. If that if there's still money left over after that, then they go to their preferred corporate bond holders. Then they're going to go to their common bond holders. Then they're going to finally pay out to their corporate shareholders. So there is still that natural chain of ownership, which does end up mitigating a lot of that risk.
Yes, and before we go forward, because there was a lot of things that you mentioned in there, in that segment, that I think after understanding the certain risks that come with investing, it would be a lot more relatable. So the two risks, the first risk I mentioned before, uh, which is unsystematic risk. This risk has to do with the certain business, the certain industry, firm. It essentially risk that you can diversify away. So there's business risk, poor economic performance from a company, in terms of the sports betting point, poor team performance, poor team chemistry, things like that. And then there's credit risk. This has a lot to do with bonds. So Moody's or Standard and Poor's, S&P 500, they'll output their list of company credit ratings. They'll give their companies ratings on how credit worthy they are, and this would be to buy corporate bonds. Um, and usually, the lower the rating, the lower the bond price, and vice versa. And the reason for that is the lower credit rating means that they're more likely not to pay you. I forget what the range is on that, but there is a range. I think it goes from double B at the lowest to triple A at the highest. Uh, but then you have liquidity risk, which this is risk that you won't be able to sell an equity, or that when you get a bond, you're not going to be able to sell it. Essentially, how likely are you to be able to, like you mentioned before, how likely are you to get your money back if a company does go under, or if a market goes under, or devalues? How likely is it that you're able to sell it and get out as quick as you can? And then the last unsystematic risk is concentration risk, which concentration risk uh, has a lot to do with diversification. So concentration risk is the risk that is the risk of losing your investment value because you're not diversified. So it's one extra step. Essentially, all of those risks, like I said before, can be diversified away, which is why in a inefficient market normally doesn't account for unsystematic risk, because it assumes that rational investors diversify that risk away. Uh, and then systematic risk has to do with
Hey, hold on.
the
I'm gonna stop you real quick, because I do want to say, we have previously talked a little bit about, the efficient markets and things like that in previous episodes. We've talked a little bit about the credit before in other episodes, and so it is really good to hit on these things again. But with these different types of risk, even though they're all called different things, they still do overlap. You can have the credit risk and the concentration risk in the same portfolio. These things are not exclusive. Um, so when you are thinking about most types of these risks, especially with the concentration risk, and you're building out your overall portfolio, if you can have either your financial advisor, or if the platform tells you itself, look for something called beta. This is what's called your correlation between the different assets within your portfolio, and that's going to tell you basically how risky it is. Um, a beta of one is going to say, well, this is just as risky as the stock market. It moves up with the S&P generally, um, because it's positive. If it's negative one, then it says it generally moves the opposite direction equally with the market. And then there's, basically every other number is going to be some fraction or direction of that. Yeah, but sorry to interrupt, but you can keep going.
Oh, no, 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 no. Yeah, important point. Yes, and beta is actually used by a lot of investment firms and private equity firms on Wall Street as part of their capital asset pricing model, which is something that's super advanced and extremely hard to uh, wrap your head around. But it is a part of that equation it can because of how it can help determine a stock's uh, volatility in relation to whatever index or market it's in. So no, very important point. Uh, my next point about risks, though, was going to be about systematic risks, and these are relatively straightforward. It's just risks that have to do with the market uh, that that actually is outside the control of the equity market. So things like changes of interest rates that are normally set by the Fed, or changes in market conditions, things that the equity markets don't necessarily affect or have control over. So, uh, uh, in terms of interest rates, they can affect stocks, but they really affect bonds because they affect interest rates and what rates the bond market ends up trading on. And so those are important things. Currency risk as well, especially if you're forex trading, so foreign exchange trading the dollar against other currencies or betting on the dollar, um, or you can do yuan against the Canadian or whatever you'd like. That there's currency risks. How likely is it that a country is going to devalue its own currency, and that can be in your favor or against you. And so those are important things to note when it comes to looking at these different markets and looking at, of course, sports betting doesn't necessarily have anything to do with those types of risks, but certainly going forward to a discussion about and equities and bonds, and other things of that nature. These types of risks are important to be on top of, and important to be looking out for. Look at what the Fed is doing. Look at what the overall market is like, what the dollar is doing against other currencies, things like that. And once again, a recurring theme uh, throughout this uh, throughout this program is diversification. Once again, the market itself is assuming, an efficient market is assuming that you diversify away your unsystematic risk, the risk that a business may fail or other things like that. And so going forward from risks, how would they affect prices? So what people what people may or may not understand is different different assets have different risks tied to them. So, uh, at real estate, will have more emphasis on systematic risk than unsystematic risk, right? Because with real estate, what affects it the most are things like neighborhood changes, or location relative to a city. How close is it? Uh, Properties around Dallas will sell for more than properties around, Plano, or things of that nature. And Dallas will sell for more than, insert small, town here. And so, uh, and then stocks will have a lot to do with unsystematic risk versus systematic risk, especially because you can just simply diversify your unsystematic risk away, and then you only have your systematic risk left. Bonds, again, are similar to real estate because they're so dependent on interest rates. If interest rates go high, remember the inverse relationship between in between interest rates and bond prices. Interest rates go up, bonds go down, and vice versa. Uh, and a company, but it will also have things that affect it from an unsystematic point of view. So a company's credit rating, a company's financial performance, things like that. And and finally, uh, recognizing recognizing when risks are heightened and when they're lower. Again, this is one of those scenarios where you just have to be on top of the market. You just have to pay attention to the economic environment, the financial environment. This will give you the best edge. And just once again, diversification. It's talked about so much because it's just that good of a strategy, especially when you consider that it eliminates one of the two major risks that you have to worry about. It essentially eliminates unsystematic risk, because if a business goes under and you're diversified, well, you still have the rest of your portfolio. But if you're not diversified and, uh, to use an old adage, you put all of your eggs in one basket or even a few baskets, well, then your loss is going to be much higher. And so, but once again, like we talked about earlier, the beta measurement, Yahoo Finance, Wall Street Journal, even Market Watch, which is owned by the Dow Jones, they have their own beta measurements that will give you a relative view of what a stock will look like compared to its industry, compared to its index, and things of that nature. And once again, stay in tune with companies' credit ratings if you're in bonds, and in terms of real estate and things of that nature. Again, you can do this is probably one of the easier research modes that research endeavors that you can do. None of them are easy. This one is just easier. But look at the locational performance of a town or a city. Does it have prospects to grow? Once again, for a college town like Austin or Norman or Manhattan or things like that. Manhattan, Kansas, unfortunately, it's the less important Manhattan. But things like that, it's important to know these things because they can affect real estate markets higher. Once again, these systematic risks that that have really very, very high stronghold. I would argue the highest stronghold um, on real estate prices. And so, in terms of risk, those are the things that you look at, and those are the types that affect different assets, different investments.
Going to the beta discussion again, there are actually tools out there that you can plug in to these tools and say, hey, I own 10% in Walmart, I own 30% in Target, I have, whatever in all these different assets, and they will actually calculate what your beta is for you. So that's one thing that you can do to make things a little bit easier. But ultimately, a lot of these discussions are what you need to be having with a financial advisor. Any good financial advisor will sit down and explain these things step by step. What's in your portfolio? How does it all correlate? What should you do in these terms? And because of that, keep in mind, we talk about seeing or talking to a financial advisor quite a lot, because at the end of the day, we don't know your specific situation. We have not done any discovery on you. We are not your financial advisors. Neither one of us at this point are financial advisors, at least for me, not anymore. So find your local professional if you want to have these more in depth discussions. What we're talking about here is just going to be a more general overview of these things. We explain economic principles, we don't give investment advice. That's kind of what things are at the end of the day. Um, But when you are reviewing your portfolio or looking at things to purchase, for most people, you just need to keep in mind when it comes down to it, a mutual fund or an index fund are generally going to be your best options. Um, there are various different ones, mutual funds, index funds, ETFs for a wide variety of different assets. You can get ETFs for a credit portfolio, which is going to include corporate bonds, treasury bonds, possibly even other types of debt and loans outstanding with companies. You can get REITs, which are REITs, real estate investment trusts. If you don't have enough money to buy rental properties, like neither one of us do, most people don't have that money or that time or that expertise, then you can just buy into a real estate investment trust and keep that in your portfolio. And these things are going to give you additional exposure to these other types of assets, these other types of markets. I mean, there's plenty of different ones. If there is something that you can think of that is financial related or an asset, I can almost guarantee that there's an easy way to buy into it. And all of these things, of course, have varying levels of risk to them, but the market rewards people that take the risks. They say high risk, high reward. That's exactly how things are. Low risk, low reward, right? You have very safe products, which are going to be things such as government bonds, treasury bonds and bills, that is, uh, various your savings account that you have with a bank, a certificate of deposit, things like that. Those are generally safe investments because with your treasuries, those are backed by quote unquote the full faith and credit of the US government, right? When you're looking at your savings account, well, number one, um, because of FDIC protection, um, every person per account type gets $250,000 worth of FDIC insurance protection on your deposits. And there are additional, um, what do they call them? Things to look at when it comes to that. It's not so simple as, hey, I have a savings account, let me get 250,000. I have a checking account, let me get 250,000. Let me just open up another account and then I get more. I get more. There are very specific things, and you can look up these rules. But generally, if you happen to have more than $250,000 worth of cash that you need to store, at a bank, $250,000 in one bank, $250,000 in a different bank, and just keep spreading them across banks, and you're going to get the full protection. That's the easy way to think about that. But the difference is because those are very low risk, because they're safe, they have very low returns. You're there are certain caveats with the bonds versus a CD, which have a little bit higher savings rate or interest rate than you would get in a regular savings account. Your money is locked up for so many times, or with bonds, if you want to pull it out earlier, then now you have to go find a market to be able to sell this on the secondary market. There are things like that versus a regular savings account where you're going to get 0.1%, 0.2, if that. So if you want to get more of a return, obviously you have to increase your risk. You have to start diversifying, your portfolio into these other asset types and moving up that risk ladder. Then you get things such as your more normal investments, which, like I said, are going to be your mutual funds, index funds, ETFs, things like that. These are safer than buying an individual stock for the simple reason that these funds are a large pool of different assets put together in one, right? So if you were to buy an S&P 500 index fund, such as VOO or SWPPX, things like that, then now you're looking at saying, hey, let me just replicate the overall stock market. And that's going to be fairly safe. If you hear someone say, "Oh, the Dow Jones went down today," or the S&P went down today, well, then you know that your index fund in that market pretty much went down. But you can pick an index for a variety of things. You can pick an index for large companies, such as the Nasdaq. You can look at small companies, such as the Russell 2000. You can look at specifically oil and gas companies. You can look at specifically international companies, and just picking 3 to 4 index funds from different areas is going to give the average person all of the exposure they need. It's going to give them all of the diversification they need. It's going to manage their risk as best they possibly can, without having to actively manage or make individual changes. All of that gets significantly more risky down the line. I mean, I have friends right now. They come talking to me about gold, silver, and precious metals, and those other higher risk investments. And people will look at what happened with silver over the last few months. It's gone up over 200%. And at this point, people are going to get FOMO, fear of missing out. Well, hey, it's gone up so much. I need to buy into it now. Well, number one, that's actually a pretty bad thing to do, for the simple fact that the worst time to buy into something is when the price is high. you know, people say buy low, sell high. That's how you make money, right? But a lot of people will chase they'll chase the way up, and then they'll get end up holding the bag when things finally drop down, and we don't want to see that. But there are those other higher risk financial products, and you know when it comes to these metals specifically, that's something that I've had the conversation with a lot of different people about. And I don't know if you have specifically, Matt, but I want to hear, like, what are some of the conversations or things that you've been telling people when it comes to actually just saying, hey, slow and steady wins the race versus chasing the high.
Right. And I'm so glad that you asked me about the metals. I thought you were gonna pass me up for that, but I'm glad that you asked. So when it comes to investing in metals, usually, so we're talking about precious metals. We're talking about palladium, gold, silver, rhodium, platinum, things like that. And usually, when people invest in these things, what they're investing in them for is a hedge against inflation, a hedge against a devaluation of the currency. You know, unfortunately, they're doing it also for the debasement of the currency. Um, and ultimately, hopefully it never happens, but a collapse of the currency. Gold and silver have been used as money since the dawn of man. Silver and gold, specifically as precious metals. Sometimes you would see palladium and platinum being used, but normally it was silver and gold being used as currency in people's coins or just in simple barter. And so, how does that translate to modern day? Well, in the silver and gold have historically been tied at a 16 to 1 gold silver ratio, which the GSR, the gold silver ratio, measures how many ounces of silver it takes to buy a single ounce of gold. And historically, this ratio has been 16 to 1. So 16 ounces of silver to buy 1 ounce of gold. And once again, that ratio was not just a hypothetical kind of ratio that was affected by governments printing money. That was okay. We have 16 times more silver than we have gold. Historically, that's been the case. And then as time went on, and especially in the United States in 1913, of course, we had the things like the Federal Reserve. And then in 1971, we removed ourselves from the gold standard. And this led to a wild change in the GSR. This led to fluctuations over time, fluctuations in prices between the two. And I actually did a college project on uh, on investing in metals versus investing traditionally in the stock market. And what that I'll bore you with I won't bore you with the details, but essentially what I found was that if you if you invested in the S&P 500 in 1993 versus and saved it for 30 years for an investment purpose, had $3,000 to spend. You could either put it in the S&P 500, in index, or you could put it in gold or silver. And of course, the S&P 500 on its own uh, destroyed the values of silver and gold. It was 48,000 for the S&P 500 versus 16,000 for silver or gold. It didn't really matter what metal you had. And then, however, there are strategies to trading gold and silver. Like I mentioned before, the GSR. The GSR has fluctuated rapidly throughout the years. And so, an example I like to use is in 2011, the GSR went down to 40 to 1. So 40 ounces of silver to buy 1 ounce of gold. And normally, the ratio stays at 80. So it's normally 80 to 1. And so 40 to 1 means that gold is cheap in terms of silver. And so what I like to tell people is, so what you can do at that point, assuming that you had your $3,000 and you invested it into silver, is you take all the silver that you bought and turn it immediately into gold. You make a GSR trade, is what it's called. And then moving forward, then when 2016 hit, the ratio was back up at 80, 85, 90 to 1. Here recently in 2022, it reached 120 to 1, which of course means the inverse of the 40 to 1 scenario, that silver is cheap in terms of gold. And so then you take all of the gold that you just got off of your last GSR trade and turn it all into silver. And what has this done for you? Well, in a relatively short amount of time, you have wildly increased the amount of silver, the amount of not necessarily silver, the amount of metals that you hold. And dude, I'm sorry, my camera stopped.
Don't worry about it. Just keep on talking. We'll fix it later.
Okay, all right. So this doesn't necessarily, so the whole point is not to continue to get more metal. The whole point is to increase the amount of money you have in metals. So with this example, you have increased, in fact, you have doubled the amount of metal, or the amount of the value of your metal, because you've doubled your metals without spending another dime on it. And so, that's a strategy in and of itself. In terms of the college project, what I did over 30 years was I traded, not necessarily peak and valley, but close to it. Assuming a rational investor would look at the historical average of 80 to 1, and when it got close to 40, 45, 50, they would make a trade. And then when it got close to 80, maybe 85, 90, they would make another trade. And assuming that, again, nobody catches the peak and valley, the end result for the S&P 500, while at 48,000, was nothing compared to the end result for silver and gold GSR trade, which was 153,000 over 30 years. And that's, again, assuming you had your $3,000 in 1993 and you didn't throw any more money into it. So I say all of that, once again, not to be boring, but to explain that there are strategies in precious metals. It is risky. It's very risky. In fact, some would argue that over the short term, it's the riskiest, and over the long run, it gets less risky as time goes on, but it still remains really risky. But it can also, as I just demonstrated, have a really large return. And so, as far as metals are concerned, that's the scenario there. Other high risk investments uh, include again individual stocks. This idea of concentration risk, of literally putting all your eggs in one basket. This is the Netflix or Facebook scenario where you think a stock is just going to go sky high, and so you throw all of your eggs in one basket. It could work for you, like those two stocks did, or it could do very bad for you, and you lose all your investment, or close to it. And then lastly, crypto, which is an extremely high risk situation. And it yields a very, very high return. And of course, turns out today, it as it turns out today, it's made a lot of people a lot of money, but it's lost a lot of people their life savings. And um, and I'm sure this is the case with you too, Nyanki. There's not a person on the street that evidently didn't know about Bitcoin in 2009 and refused to buy it. And now they're like, I could have been a millionaire. I don't think that's the case. But uh, point being, it's a very volatile market. Nobody could have predicted what happened with Bitcoin, uh, Ethereum, and whatnot. And therefore it yields the highest return if you do get a return.
Yeah, I mean, 100% exactly like you said. There are so many people that you see online because that's the world we live in, right? Where, on the internet, we basically chase, um, more or less, we chase the exciting thing. And for a lot of people, that was crypto. So, there are some people, like you said, that did make millions of dollars off crypto. There are a lot of people that lost their entire life savings off crypto. This is why the idea of pump and dump scams and just finding the next one that's going to the moon. That's why that's so um, attractive to a lot of people. Is specifically because in these scenarios they think that they can make a lot of money. But you said something that I think is very important, which is the difference between the long term and the short term. In the short term, things are very volatile and you can make a lot of money. But in the long run, whether it's stocks, whether it's bonds, whether it's um, whatever it is, over the long run, precious metals, real estate, etc. Over the long run, things tend to settle down and be a little bit safer, regardless of what asset you're going in. But overall, what that means is that it comes down to my favorite piece of it of financial advice, which I'll give to anyone, is time in the market beats timing the market. I say it all the time. You will always have the ups, you will always have the downs. And like you said, no one is going to catch all the highs, no one's going to catch all the lows. So why would you even try? It doesn't make a lot of sense why you would spend so much time trying to figure out what's the next big thing. Let me get on the bandwagon. Is this the high of the market? Let me go ahead and sell now and save. Is this the low of the market? Let me go ahead and buy in. Because over the long run, the S&P 500, depending on your source, yields between 7 and 10% over the long run per year. That is over the long run. Now there is, of course, the whole thing about sequence of returns risk, where because there are some years where it might go up 30%, there's some years where it might go down 20%, where the closer you are to needing that money, the more of a risk it is to leave everything in a riskier investment. Because if you're 1 year from retirement and then you catch that negative 20 year, well, now you're going to say, well, hey, I gotta work a couple more years. I can't retire right now. So that's one of the main reasons why, um, especially when it comes to retirement funds and things like that, a lot of companies and servicers will offer what they call lifetime funds or life cycle funds, which basically does the work of that a financial advisor would do of when you're younger. Then they're more invested into equities and those slightly higher risk things. And as you get closer to retirement, as you get older, then they pull a lot of that money out and get closer into cash reserves and into bonds, which are going to be your safer, more backed things. And the whole reason is, of course, to mitigate that sequence of returns risk. But with that in mind, here's the fun part, right? This is the part where we talk about, now that we've gone through all of those things, we've talked about all these different types of products, we've talked about all these different types of methods, all these different metrics and things like that to look at. What does it mean for me? How do I change my portfolio? How do I work with things? Well, number one is that thing that I just said before. As you get older, as you get closer to retirement, shift your assets into more safe things. Um, when you're younger, you can afford to be more risky, but specifically what that risk is of course going to be dependent on number one, what's your expertise? Um, Number two, how long do you think it will be before you need this money? Some people retire earlier, some people retire later. Some people want to use their money for other things before they retire. Those are considerations you need to have. And then number three, which is the big thing, what is your specific risk tolerance? Once you have figured all these things out and your financial advisor or your banker, whoever you work with, is extremely likely to help you out with this because it's part of their job, part of their discovery. Once you figure out all those things, they will come up or you will come up with a blend of at this point in my life, if I'm 25 years old, extremely high risk, making a moderate amount of money, and I already have an emergency fund of 3 to 6 months of expenses built up outside of this investment account, and I'm also separately funding my retirement with a 401k through my employer, making sure I'm getting my full match. Well, then you can say, well, hey, I'm 25 years old. I've got 40 years ahead of me before I plan to retire. Let me just throw 80, 90, 100% of it in various index funds and mutual funds. Or, hey, I want to get involved in some of the more risky things. I want to look I want to look at the crypto. I want to look at sector funds. I want to look at the individual stocks. Well, then you take a portion of your portfolio and you put it in there, whether it's 10%, 15%, 20%, whatever works for you. Um, so that's the first thing to keep in mind. Figure out your needs, figure out your goals, make a portfolio accordingly. As you get older, shift that portfolio into getting safer. If you want to take a look at once you have more money, getting rental properties, which is a high risk thing for various reasons. If you want to look at getting involved in venture capital or direct investment into a company, whether it's like I said, venture capital, whether it's a private placement, whether it's going out and finding one in your community, whether it's investing or purchasing a company online, all these things exist and they are all extremely high risk. Whether it's hedge funds and things like that, where they're putting your money and investing it into long short strategies, which are very, very risky, and most people can't get into them until you become what's called an accredited investor. If you want to get into all of those things, that is perfectly fine. That is great. Talk to a financial advisor and they will point you in the right direction. If you have the time and the desire and the knowledge to do your research on your own, that is a great time saver because most financial advisors are going to charge you somewhere around 1% of your portfolio per year, regardless of if it makes money or loses money that year. So if you have the time, knowledge, and dedication, feel free to do your own research. Feel free to learn about all these things just like we did. But of course, we paid for this opportunity to some degree. We paid for school. We got the student loans. We're in the MBA program right now. We're spending the money. We're putting our money where our mouth is, so to speak, and learning these things. And now we're bringing them to you, different levels of at different levels of complexity, because we care about sharing our knowledge and we care about, especially for our generation, making sure that we will have a safe and financially secure future. So these are things that we need to know about. We need to know about how, the people go from zero money in the bank, I'm in debt, what can I do, to, hey, I'm financially free and now I can go travel the world. You know, this is the purpose of this channel, the purpose of this podcast, the purpose of our videos, the purpose of our discussions is to try at least to make a dent and make life better for ourselves, for you, our viewers, and for your family members and your friends and the people that you talk to. So with all that in mind, um, you know, I think that for the most part, that's really where your basic strategy should be. We can talk all day and night about what I should invest into specifically, what products are right for me. But again, as I said earlier, we're not your financial advisors. We don't have that ability. We don't know what your specific situation is. So whether or not you want to get into sports betting, prediction markets, index funds, buy rental properties, whatever it is, you've got to think about what's right for you.
Right, right. And just to add on to all of that, the thing that the market cannot predict is your mind, your knowledge, what the time that you spent in research, the stocks that you've decided based on your own analysis. These are things that the market can account for, won't account for, and like my co-host said, uh, and one thing that I'm very passionate about as well is we've inherited an economy that some would argue, I would say a lot would argue, is not it's doing better, but it was once a lot better in terms of what generations could afford, what posterity could afford, what assets were on the market, availability of assets, things like that. And so all that I want to do and all that my co-host wants to do is make sure that you are aware of these strategies, that you are aware of your resources, that once again you build up your mind with these useful techniques and useful strategies. Once again, if diversification didn't work, then people wouldn't do it, but it does. Um, and so there are a lot of people who diversify. There are a lot of people who don't diversify because they're not aware of how useful this is. Uh, and to those people, I would say you should tune into this. You should tune into this channel and hear about how useful it is, how much risk you are taking on that you don't need to take on. And if you just invested in other baskets, then maybe you wouldn't have to deal with those risks anymore. And so, once again, uh, knowledge is your uh, knowledge is your largest advantage in this market, and we just want to help spread that around, especially to other young people who are in this economy, possibly struggling, and definitely not sure what to do, not sure what to make of it, and what opportunities exist for them. And so that's what we're here for. That's what we're passionate about, and that's what we'll continue to do.
Yep, 100%. That sounds great. So, like you said, ultimately, the best bet that you can make is on your own financial literacy, knowing exactly what you own, from safe bonds to volatile crypto. Remember that the market rewards you for taking risks, but only if you diversify wisely, as myself and Matt have said previously. You have to protect yourself from the risk that you can't control and do your best to not add additional risk that you can control. So, from myself and my co host, Matt White, thank you very much for tuning in. Comment your thoughts down below if you have any questions or anything else that you'd like us to talk about specifically, and we'll do our best to have it featured on the next or future episode of the podcast. Like and subscribe if you want to stay up to date. New episodes come out every Thursday. We also have additional videos and snippets coming out throughout the week as well. Um, Again, thank you very much for listening. This is Road to Riches.